Welcome to the deep dive. Today we're looking into analog devices, ADI. They've been a major player in semiconductors for, what, almost 60 years now?
That's right, a real veteran.
And the big question, the one we really want to dig into, is this. Is ADI the company that has to be there for our digital future, that essential bridge? Or is it maybe a legacy giant facing some pretty serious headwinds that could challenge where it's valued today?
It really is a fascinating picture. On the surface, they look perfectly set up, right? Riding these huge tech megatrends.
Yeah.
But then you dig into certain details, especially like how the insiders seem to value the company through their actions, and it throws up this interesting paradox we'll get into.
Absolutely. So our goal here, our mission for this deep dive is pretty straightforward. Quickly pull out the most crucial bits of info, the real nuggets, to help you get properly informed about ADI.
And we're using a really thorough analysis from the stockanalytics.ai expert team. All the data is current as of June 20th, 2025. ADI's stock closed at $220.35 per share that day.
Right. We'll cover the business itself, the management, the financials, of course, what the market thinks, who owns the stock, and the risks involved.
Exactly, giving you that full sort of 360-degree view.
Okay, so to keep it organized, we've split this into two parts. Part one, we'll lay the groundwork. ADI's business, the management team, and the financial health.
And then in part two, we'll shift gears, look at the market dynamics, ownership risks, and, wrap it up with our conclusion.
Sounds good. Let's jump into chapter one, business analysis. So when we talk about ADI, what is their actual role? They're not making the CPUs, the brains, right?
No, not the brains. Think of them more as the nervous system, maybe. They operate right where the physical world meets the digital world.
Okay.
So they create these critical components that let digital systems sense, measure, and interpret real-world things, temperature, sound, pressure, motion, converting that into digital language. They're essentially the translators.
Translators, I like that. And how does the money flow? Where does their revenue come from?
It's pretty diversified, strategically so. About 40% is direct sales to the big equipment makers.
Yeah.
But interestingly, almost 60%, 58% actually, comes through third-party distributors.
Okay.
And the key thing here, strategically, is that 87% of their revenue is from business-to-business or B2B applications. These tend to have really long life cycles, very stable. It helps them avoid that, crazy up and down you see in consumer electronics.
In a sense, less volatile.
Exactly. For fiscal 24, the breakdown was roughly: industrial was the biggest chunk at 46%, automotive at 30%, communications 11%, and consumer only about 13%.
And I read their product list is enormous, something like 75,000 different products. Can you break down the main categories? How do they fit that translator idea?
Yeah, it's vast, but they mainly fall into four key groups. First, you've got data converters. These are the ADCs and DACs, analog to digital and digital to analog, literally the translators.
Right.
An ADC takes, say, sound from a microphone, turns it into digital ones and zeros. A DESI does the opposite, digital back to analog for a speaker. That's like their core heritage.
Okay, what else?
Second, amplifiers and RF microwave ICs. These basically boost weak signals really precisely without adding noise. Crucial in things like medical scanners or 5G cell towers.
Got it.
Third, power management ICs. These guys make sure power gets delivered efficiently. Think better battery life in your phone or managing the complex power needs in an electric car.
Essential stuff.
Definitely. And fourth, sensors and MEMS, that's micro-electromechanical systems. Tiny little machines, basically. Sensing motion, pressure. You find them everywhere, from airbags in cars to your smartphone.
So ADI is clearly a global leader serving, 125,000 customers. But you mentioned their overall market share is maybe 6.7% smaller than some others. What's the strategy there?
Yeah, that 6.7% figure is, it's really revealing. They're not trying to be everything to everyone, like, say, a Broadcom or maybe TI across the whole market.
Right.
ADI's game is different. They're a high-performance niche dominator. They focus on applications where performance is absolutely critical. And because of that focus...
You need to charge more.
Exactly. Their average selling prices are roughly 4 times the industry average, and customers consistently rank them number one for product quality and service. It's how they achieve those industry-leading adjusted gross margins around 68%. It's quality, performance, not just volume.
So it really sounds like customers aren't just picking a part off a shelf. They're partnering with ADI, using their expertise to solve tough problems.
That's precisely it. It's a deep, collaborative relationship. They're solving complex engineering challenges together.
Okay, let's talk about the industry context. Semiconductors are famously cyclical. ADI seems to be in an upturn now, bookings accelerating. How does that fit with the bigger, longer-term picture?
Well, the current upturn is obviously good news, but the real story for ADI is plugging into these massive long-term secular trends. These are the tailwinds.
Like what specifically?
Okay, think about artificial intelligence. AI needs tons of high-quality, real-world data. That means sophisticated sensors and converters right in ADI's sweet spot.
Makes sense.
Then there's the huge automotive transformation. EVs, autonomous driving, the amount of semiconductor content in cars is just exploding. ADI is big in battery management systems, infotainment, driver assist systems.
Right, ADIs.
Exactly. And then industrial automation, Industry 4.0, factories getting smarter, more connected, needing advanced sensing, measurement, control. Again, core ADI territory.
And communications.
Yep, communications infrastructure. Think 5G build-out, Wi-Fi 7, all demanding high-performance RF and microwave components. These aren't just short-term bumps. They're foundational shifts driving demand for decades.
And the whole industry is projected to grow massively, right? From $600 billion now towards maybe $1 trillion by 2030.
The numbers are staggering, yeah. Projections point towards 700. 2030 seems achievable.
In this huge growing market, who are their main competitors? Who keeps them on their toes?
The main rivals are familiar names. Texas Instruments, NXP Semiconductors, ST Microelectronics, Microchip Technology. They all compete, but often in slightly different areas or with different strengths. ADI tends to lead on that high-performance edge.
And what about the regulatory side? Things like the U.S.-China situation must be a constant factor.
Oh, absolutely. Geopolitics, especially U.S.-China tensions, means things like export controls, tariffs, that can really snarl up global supply chains and affect market access. It's a big uncertainty.
And environmental rules.
Yes. Increasingly strict environmental regulations worldwide are also a factor, especially around manufacturing things like water use, energy consumption.
What makes it so hard for a new company to just jump into this high-performance analog space? What are the barriers to entry?
It's not just about money, though. You need plenty of that. The real barrier is intellectual capital, human capital, analog design. It's often called more of an art than a science.
An art.
Yeah, it requires this deep, almost intuitive knowledge built up over years, decades even. It's incredibly hard to just, teach that quickly or replicate it. Plus, there just aren't as many skilled analog engineers globally compared to digital ones.
Yeah.
That talent pool is a huge barrier.
So putting that all together, the expertise, the market position, the barriers, what is the ADI's competitive advantage?
Yeah.
Their economic moat.
They've got a few strong ones. First, brand strength. Almost 60 years, the name means quality, innovation, especially in B2B. Second, cost advantages, not necessarily the lowest cost, but smart cost management through their flexible manufacturing using both their own fabs and external foundries.
Okay.
But the biggest, most durable moat, that's the network effects and switching costs. This is key. About half their revenue comes from products they launched a decade ago.
Wow, really?
Yeah. Think about it. You design an ADI chip into, say, an MRI machine. That design process, the testing, the regulatory approvals, it costs millions and takes years.
Right.
So once that chip is designed in, the cost and risk of ripping it out and replacing it with a competitor's just to maybe save a few bucks on the component, it's enormous. It dwarfs the component cost. Customers are essentially locked in for that product's whole life cycle.
That MRI example really drives it home. That's serious lock-in.
It is. And finally, their unique assets. That's their 13,000 plus engineers. They're not just selling parts. They're acting as collaborative engineering partners, building really deep relationships.
Okay, let's shift gears. Chapter 2, Management Evaluation. Tell us about the CEO, Vincent Roche.
Vincent Roche is a lifer, practically. Joined ADI way back in 1988, became CEO in 2013. He's only the third CEO in the company's entire history.
That says something about stability.
It really does. And his track record is strong. He took revenue from around $2.7 billion in 2012 to over $9 billion now, mainly through those big, bold acquisitions, Lineal Tech, Maxim Integrated. He seems very adept at steering the ship through the industry cycles, including COVID, and his recent commentary has been quite confident, forward-looking.
What about transparency and sort of their ethical standing?
Communication seems pretty standard for a large public company. Regular calls, reports. Roche generally comes across as quite candid. Ethically, they seem solid. Sustainalytics gives them a low-risk ESG score, a strong rating. S&P Global pointed out their leadership in sustainability, like aiming for 100% renewable energy by end of 2025.
That's ambitious.
Yeah.
So how do they decide where to put their money? What's the capital allocation strategy?
It's pretty clear-cut, actually. First, internal investment. They consistently plow nearly 20% of revenue back into R&D. You have to in this business to stay ahead.
Absolutely.
Second, as we mentioned, transformative M&A. Linear Tech in 2017, that was $14.8 billion, really beefed up their power management and industrial auto side. Then Maxim integrated in 2021 for $21 billion. That brought scale, talent, especially in automotive and data centers.
Huge deals.
Massive. And more recently, there's a bit of a shift towards ecosystem building. They just launched Adventures in June 2025. That's a corporate VC fund. Smaller, strategic bets on startups in robotics, climate, health, plus things like industry associations to set standards. It signals they're thinking like a mature leader shaping the future.
And what about returning cash to shareholders?
Oh, they're very committed there. The stated policy is to return 100% of free cash flow over time through dividends and buybacks.
100%.
Yep. The dividend track record is impressive, 21 straight years of increases. The latest was an 8% bump to $0.99 a share quarterly. And the buyback program is hefty, another $10 billion authorized in Feb 2025, bringing the total authorization to $11.5 billion. That's like 10% of their market cap.
Okay, those big acquisitions you mentioned, Linear Tech, Maxim, sometimes big deals can really drag down efficiency metrics.
Yeah.
How has that affected something like return on invested capital, ROIC? Is that a worry?
That's a really sharp question, and yeah, it's something to watch. ROIC basically tells you how well a company uses its capital to generate profit. Historically, ADI was great, like 12.88% back in 2016.
Yeah.
But after spending billions on those acquisitions, their invested capital base ballooned, mainly with goodwill and intangible assets on the balance sheet. So mathematically, the ROIC calculation takes a hit. Right now, it's around 4.04% for fiscal 24, 4.6% trailing 12 months.
How does that compare?
It definitely lags peers like TI, which is over 16%, or NXP around 14.6%. It's closer to Microchip, around 4.1%. The key thing isn't just the number today, but where it's headed. Investors really need to see profits grow faster than that expanded capital base to validate those deals long term.
Right, validating management strategy. Okay, let's get into the numbers. Chapter 3, financial analysis. Can you give us that snapshot as of June 20th, 2025?
Sure. Market cap was about $113.3 billion. Revenue trends, you can really see the story. Big 64% jump in fiscal 22 after the Maxim deal. Then the cyclical downturn hit, down 23% in fiscal 24.
Knuckles are real.
Oh, yeah. But even through that dip, their free cash flow generation is consistently strong. Profit margins look healthy, too. GAAP gross margin, 61%. GAAP operating margin, nearly 26%. Net margin, around 18.65% trailing 12 months. They turn out cash $3.12 billion in free cash flow, even in that down year, fiscal 24.
So what does that suggest about their overall financial stability?
It suggests they're rock solid, fundamentally. Profitable for over a decade straight, no annual losses. The balance sheet is super conservative. Debt to equity is only 0.19, like 19%. They've actively paid down debt from over 50% 5 years ago.
That's quite a change.
Yeah, very prudent. Their current ratio is strong at 2.08, meaning plenty of liquidity, and that 21-year dividend growth streak. That speaks volumes about financial discipline. You might see a high payout ratio if you just look at GAAP earnings, but based on free cash flow, it's around 58%, which is perfectly healthy and well within their target.
Okay, strong foundation, solid financials. So the obvious next question, how does the market value all this? What's the valuation picture look like?
All right, this is where it gets a bit more complex. If you look at the standard PE ratio, price to earnings, on a trailing 12-month basis, ADI is sitting around 62.
62. That sounds high.
It is, yeah. Significantly higher than its own 10-year average, which is closer to 35. And way above peers like TI at maybe 37 or NXP around 23. It tells you the market is baking in a lot of optimism about future growth.
So besides comparing to others, what about intrinsic value? Like, what's the company actually worth based on its future potential?
That's where you get into things like a discounted cash flow or DCF analysis. The idea is to estimate all the future cash the company will generate and figure out what that's worth today, like the present value of all its future paychecks, basically.
Okay.
So running an educational two-stage DCF model using consensus forecasts spits out an estimated intrinsic value of around $233 per share.
$233. That's pretty close to where it's trading now.
It is, but, and this is crucial, DCF models are very sensitive to the assumptions you feed them. You know, growth rates, discount rates.
Garbage in, garbage out.
Sort of, yeah. Other models we looked at in the research gave a much wider range, maybe $139 up to $208. So that $233 depends heavily on things like FCF, starting at $3.99 billion in 2025, using a 9.4% discount rate, and assuming a pretty conservative 2.8% long-term growth rate. Point is, there's definite uncertainty around any single value estimate.
Okay, good context. Let's move into part 2 now, looking at the market view and the road ahead. Starting with Chapter 4, Market Sentiment. How was Wall Street feeling about ADI?
Generally positive, leaning bullish. The consensus among analysts is typically a moderate buy or buy. The average price target for the next 12 months falls somewhere between, say, $245 and $252.
So some modest upside from the current $228.
Yeah, modest on average. But the range of those targets is really wide, from as low as $155 to as high as $300. That shows quite a bit of differing opinion out there. It's also worth noting many firms boosted their targets right after that strong Q2 earnings report back in May.
Right, that Q2 report was a big deal. They beat expectations, and CEO Roche sounded really upbeat about the recovery, accelerating bookings and all that. That definitely seemed to fuel the recent stock run.
Absolutely. And you see that reflected in other market indicators too. For instance, short interest. The percentage of shares bet against the stock is super low for ADI, only about 1.46% of the float.
How does that compare?
It's way below the peer average, which is over 5%,
Heck
and
yeah.
it's been trending down. That suggests very few people are making big bets that the stock will fall. Low bearish sentiment.
Okay, and technically, looking at the charts.
Technically, it looks strong too. The share price, $228.35, is trading quite comfortably above both its 50-day moving average, which is around $210, and its 200-day moving average, maybe $211 to $215.
So breaking above those key levels.
Yeah, that decisive move above the moving averages, combined with that low and falling short interest. It kind of provides market-based evidence backing up that fundamental story of a recovery taking hold. The market seems to believe it.
Interesting. Okay, next up, Chapter 5, Ownership Structure. Who actually owns ADI stock?
Well, institutions own a lot of it, somewhere between 69% and maybe even 87%, depending on how you count it.
Right.
We're talking almost 2,900 institutions holding over 500 million shares.
Wow. Any big names?
Oh, yeah. It's heavily concentrated in the huge passive index managers. Vanguard has nearly 10%, BlackRock almost 8%, State Street over 4.5%.
So mostly index funds. What does that mean for the stock?
It provides a certain stability, a solid base of ownership, but it also means the stock can be influenced by big macro flows, Money moving into or out of large cap index funds can push ADI around, sometimes regardless of its specific news.
Okay, that makes sense. Now, this raises a really critical question. If institutions own so much, what about the insiders, the people running the company? What are they doing?
Ah, yes. And here's where that paradox really comes into focus. In complete contrast to the huge institutional holdings, insider ownership is tiny, like 0.3% or 0.4%.
Very low.
Extremely low. But what's really striking, fascinating even, is the pattern over the last year or so. It's been consistent, significant insider selling, and critically, zero open market purchases by key insiders.
Zero buys. Who's been selling?
We've seen sales from CEO Vincent Roche totaling around $14.8 million in the last 6 months based on estimates. Founder Ray Stata sold over $2.3 million, likely more before that. EVP Vivek Jain sold about $2.7 million. It's a clear pattern across the senior leadership.
Okay, hold on. Market sentiment is bullish. Analysts are raising targets. The stock is technically strong. But the insiders, the people who know the company best, are consistently selling and never buying. What do we think of that?
That's the million-dollar question, isn't it? It creates this really stark contrast. Now, sure, insiders might sell for personal reasons, diversification, taxes, buying a house, whatever. That happens. But the consistency of the selling across multiple top executives, including the CEO and the founder, coupled with the complete absence of any buying, even when the stock price was lower. That's a pretty significant signal. It strongly suggests that, in their view, the current stock price might already fully reflect or perhaps even exceed the optimistic outlook. It's a major red flag regarding their perception of the valuation.
A critical paradox, as you said. Okay, and just quickly on ownership concentration.
Yeah, just to reiterate, that heavy concentration in the top few institutions means that if one or two of those giants decides to rebalance or trim their position, it could exert significant selling pressure, potentially unrelated to ADI's actual performance.
Understood. Okay, let's turn to the potential downsides. Chapter 6, Risk Assessment. Can you give us the highlights from the SWOT analysis? Strengths, weaknesses, opportunities, threats.
Sure, let's break it down. Strengths. We've covered these: dominant and high-performance analog, great brand, that sticky customer base due to switching costs, the moat, diversified B2B income, strong cash flow, shareholder-friendly policies.
Okay. Weaknesses?
Weaknesses, they're tied to the semiconductor cycle that's inherent, complex global supply chain, heavily reliant on Asia, need constant R&D spend. And as we just discussed, that very low insider ownership and pattern of selling is a weakness from an investor perspective. Plus, the recent revenue declines, even if cyclical.
Opportunities.
Opportunities, huge ones. Those secular tailwinds, EVs, automation, 5G, AI, IoT, potential to sell more products to Maxim's old customers, strategic growth from that new Adventures CVC fund.
Have threats.
Threats, intense competition, especially from TI. Geopolitical risks, particularly U.S.-China trade stuff, the risk of a deeper or longer industry downturn than expected, and rising costs from inflation impacting manufacturing.
Let's dig into those threats a bit. How do big macro factors like inflation or interest rates hit ADI specifically?
Well, inflation directly squeezes margins by increasing costs. Silicon wafers, energy, labor. The premium pricing gives them some buffer, but they can't always pass everything on.
Right.
Interest rates are a double whammy. Higher rates mean higher borrowing costs for ADI itself if they need debt. But maybe more importantly, higher rates can make their customers pull back on big capital projects. If it costs more to borrow, businesses might delay building that new factory or buying new equipment, which means less demand for ADI's components.
Makes sense. And the geopolitical side, you mentioned U.S.-China. There's talk about potential broad U.S. tariffs, maybe 25% or more, on semiconductors in 2025. What would that mean?
Oof, yeah, that's a major potential disruptor. Broad tariffs like that could cause immediate supply chain chaos and cost hikes, just friction everywhere, making production more expensive.
And demand.
It could reduce end market demand.
Yeah.
If tariffs make final products like cars or medical devices more expensive, consumers and businesses might buy less, which ultimately hurts ADI's orders.
And longer term.
It would definitely accelerate supply chain realignment. Companies are already looking to diversify away from single regions. Tariffs would just pour gasoline on that fire, forcing faster moves towards friendshoring or regional hubs. That creates a lot of uncertainty and cost during the transition.
Okay, a lot to consider there. Let's try to wrap this all up. Chapter 7, Conclusion. Based on everything we've discussed, what's a core argument for ADI? The bull case.
The bull case is strong, fundamentally. You have a truly high-quality business here. It's got that wide economic moat we talked about, sticky customers, strong brand, deep engineering talent, guided by a stable, experienced management team that knows how to navigate the cycles and has pulled off big, transformative deals. And their capital allocation is just textbook shareholder-friendly, aiming for 100% FCF return, 21 years of dividend hikes, big buybacks.
And the future.
And crucially, they are perfectly positioned to ride those powerful long-term waves: electrification, automation, connectivity.
Yeah.
Future seems to require exactly what ADI does best.
Okay, compelling case. But what about the other side? What are the main worries? The bear case.
The biggest flashing light is valuation. That high PE ratio suggests the market has already priced in a very strong recovery. If that recovery stumbles or isn't quite as strong as hoped, the stock looks vulnerable to a pullback.
What else?
Then you have those external threats, primarily geopolitical risks like a U.S.-China trade war escalating with tariffs, which could hit supply chains and demand hard.
And the insider activity.
And that's probably the most concrete worry right now. The insider activity, that consistent, heavy selling by top execs with zero buying. It's hard to ignore. It's a significant signal about how they perceive the current valuation, regardless of the broader market optimism. It's a critical red flag.
So revisiting the valuation summary.
Right. Our educational DCF model suggested around $233 per share intrinsic value, using certain assumptions. But remember, other models showed a much wider range, 139, 38 tells us. It just underscores the uncertainty inherent in any forecast.
So tying it all together, what does this mean for you, the listener?
As of that June 20th date, ADI's stock at $228.35 was trading right near the upper end of that estimated value range. So while Analog Devices is without doubt an excellent company, great moat, strong management, plugged into the future, the current market price seems to reflect a whole lot of optimism already.
Right.
And that stark contrast, that paradox between the bullish market view and the, frankly, bearish insider actions, that's the core puzzle for potential investors right now. The evidence seems to suggest that while ADI is a fantastic business, the stock might be pretty fairly valued today, leaving maybe limited room for error, a limited margin of safety at the specific price point.
So the ultimate question remains, how do you weigh a truly excellent company, seemingly set for future growth, against actions from those who know it best that scream caution on valuation? That's the deep dive for you to mull over. And if you found this kind of analysis valuable, please consider subscribing to Stock Analytics AI. For just $4.99 a month, members get priority access to deep dives like this one. Plus, heads up, over the next few months, we're planning to cover all of the S&P 500 stocks exclusively for our members.
And the necessary reminder, this analysis was generated by an AI system for educational purposes only. It should definitely not be taken as financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.